All right. What's up, guys? Hope you're doing well. James here from jamesdforsythe.com. And taking a second to go over a recent speech given by Vice Chair Brainard, right, on bringing down inflation. So even she's really getting into it, I guess you could say. So with that being said, go right up to screen share, right? And this was given at the Clearinghouse and Bank Policy Institute of 2022 annual conference, right? And so basically, due to multiple waves of the pandemic combined with Russia's war against Ukraine, unleashed a series of supply shocks hitting goods, labor, and commodities that, in combination with strong demand, have contributed to ongoing high inflation, right? With a series of inflationary supply shocks, it is especially important to guard against the risk that households and businesses could start to expect inflation to remain above 2% in the long run, which could make it more challenging to bring inflation back down to target, right? And so, kind of a few things. At least they're talking about supply shocks now. It's not just kind of like a shrug, we don't really know sort of thing. Um, However, it's still like, especially with the Russia comment, with the war in Ukraine and that sort of thing, it's one of those, a lot of the problems, and I think explicit or specifically like with natural gas, to use an example, like you see the spike in price happen before Russia invaded Ukraine, right? And so, not saying that the whole invasion helped in the slightest, or that it wasn't a factor and it continuing to go up, but it was already a problem beforehand, right? And so you kind of see that across the board. And one of the things with these inflationary supply shocks, right, is, at least that they're worried about, I guess I should say, is the whole inflation expectations and keeping them anchored, right? Because if there's no goods to buy, it's kind of hard to expect inflation to come down because you don't have that increase in supply to, help bring prices down. The whole supply and demand dynamic, right? That's always something you have to keep in mind. So, while last year's rapid pace of economic growth was boosted by a combination of fiscal policy and monetary policy, as well as reopening, demand has moderated this year as those tailwinds have abated, right? I mean, when you come from such a low baseline due to what happened in 2020 and the pandemic and all of that, um, you would hope there'd be economic growth in a way. It's one of those, do you really define it as growth because it's coming, I mean, just back to trend in a way? And you kind of see this with the whole labor market argument and that sort of thing, is how it's so strong and there's so many millions of jobs that were created. But it's like when you look at the jobs report from, I even did a video on this, I think specifically, there was only like one or two sectors of jobs in which they actually got above what they were in 2019, right? A lot of them still, even though they're citing like all this growth and everything, they're basically moving the baseline to the, basically the trough of the graph, because that was during the pandemic, right? And they're not actually looking at it from a, I guess, quote unquote normal job market in a way, right? And so you really have to look into how exactly they're using data. That's something you just have to look at, right? That's one of the biggest things I've noticed when I started looking into this stuff more, was you have to pay attention to how exactly things are measured, because it's really, really easy to misinterpret things if you don't understand how such indicator is measured to begin with, right? And so basically, to continue, a sizable fiscal drag on output growth alongside a sharp tightening in financial conditions has contributed to a slowing activity, right? And I'm going to go and catch up some of these graphs. And so it's one of the things I like about these Fed graphs sometimes, is that they actually put them in the speeches, or they'll link them to what they're saying. So here's the first one, and this is headline inflation for selected countries, which include Canada, the Eurozone, UK, and the US, right? So the US is this kind of the thicker, or I'm sorry, the smaller blue line, right? The blue dashed line, I guess. I need to turn on my brightness. Sorry. But, anyways, so you have the UK, right, coming up here to about 10%. General trend, obviously, you see kind of months after 2020, and it really starts to take up in the late 2020s, early 2021, to where it's kind of like the fiscal stimulus had all the stimulus checks were coming out, right? And all of a sudden we see inflation start to go up, right? And I kind of want to, I guess, contrast this to the concept of QE, to where it's like, where are we really seeing an increase in consumer prices? And it's not in QE, it's when we give actual people the the money itself, right? Not necessarily keeping it within like the financial system itself. It's the difference between like the financial economy and the real economy, right? And how you kind of inject, quote unquote, that liquidity in a way. At least that's what comes to mind, right? And so we have here figure two, kind of breaking apart growth of real GDP, PCE, and residential investment, because housing is a major factor for anyone's expenses, right? And so basically, you have real GDP is this solid line, real PCE, and then real residential investment. And so you kind of see that they pretty seem pretty well correlated, it seems, with a few changes with respect to the residential investment, depending on the time period. Um, but yeah, kind of hovering around zero, which I'm assuming this is a percentage change graph. Yeah. And so you kind of see, especially going into 2020, and this is one thing you have to kind of, I think, raise your eyebrows about, is what was happening before 2020 economically, where real GDP just started to go down, right, relative, and then spike up in 2020, right? Or I guess, yeah, about early 2020. But anyways, I haven't looked too far into that specifically. It's just something I noticed looking at this right now. So the concentration of strong consumer spending in supply constrained sectors has contributed to high inflation. So consumer spending is in the midst of an ongoing but still incomplete rotation back toward pre-pandemic patterns. Real spending on goods has declined modestly in each of the past 2 quarters, while real spending on services has expanded at about half its 2021 growth rate. Right. So this is something I think I made I don't remember if I made an explicit video about it, but I know I at least talked about it months ago in 2021. Um, Basically about this kind of rotation of how, and you could really see it in inflation with how people changed their spending habits during the pandemic, which makes sense, obviously, because especially with lockdowns and that sort of thing, you weren't able to go out and get a lot of services, right? So you saw services go significantly down, whereas most of the inflation was weighted towards goods. And so now you're kind of seeing the opposite start to happen as, things are quote unquote back to normal. And so you kind of have this rotation back to where you're seeing services inflation start to increase significantly, right? And so, and you're starting to see this if you want to get anything done, like even just going to get a haircut, I've noticed. So to continue, the level of goods spending remains 5% above the level implied by its pre-pandemic trend, while services spending remains 4% below its trend, right? And so it's kind of playing catch up in a way, right? And you can see this with this sort of spread where you have goods and services, right? So services, you see the pandemic happen and that just tanks. Well, both of them tank, but goods bounce up significantly, right? And then you have services still below their trend line from 2014 to 2019, right? But it's still like it's coming up. They're both starting to level off, but it's still something to keep in mind, right? So while price increases in food and energy are weighing on discretionary spending of all Americans, they are especially hard on low income families who spend three-fourths of their income on necessities such as food, gas, and shelter, more than double the 31% for high income households. Um, Basically, yeah, if you think about it, I mean, inflation impacts everyone differently. If you really want to argue, it seems like every individual can have kind of their own personal CPI in a way. Um, but because we all buy kind of a different types of goods and services, right? And so, like, depending on your diet or where you live and that sort of thing, right? And so But if you think about it, lower income households, and she specifically says like food, gas, and shelter. They're all kind of, we all need those things. They're all fixed relatively on how much we need, right? And so basically that's a set kind of amount. And so depending on your income, that's going to take a, I'm going to say inversely proportional percentage of your income relative to the level of your income, right? So the lower your income, the higher the percentage of your income that you're going to have to pay for these, because these are essentially fixed costs in a way. Yeah, they can fluctuate, and you can change kind of weightings and what exactly you're buying, but you have to eat, you have to buy gas, and you have to have a home for the most part, or at least live somewhere, right? Um, unless you basically take a massive hit to your standard of living. Like this is essentially food, gas, and shelter is how you essentially define your standard of living, right? So you have to keep that in mind. And so the higher your income, the lower of a percentage that you of your total income is going to be spent on those things. And according to this, and I believe this speech three was given by Miss Brainard as well. So variation in the inflation experiences of households. Sorry, yeah, given by Lael Brainard. So that's down there as well, and you can always look in the footnotes for sources and stuff. Find my spot. Right. And so going on towards gas, so the rise and fall of gasoline prices played a major role in the dynamics of inflation over the summer, so contributing 0.4 percentage points um, to month over month PCE inflation. Remember that PCE is the Fed's kind of preferred measure of inflation, not necessarily CPI. That's kind of more of like a headline number, it seems. And this was in June, and then subtracting 0.2 percentage points in July, right? So this is a total of over half a percentage point swing just from the contribution of gas prices to PCE, right? And so basically, they say this was an important factor or driver in the decline of month over month PCE inflation from 1% in June to negative 0.1% in July, right? So it's just over half, because that's a swing of basically 1.1%. And so you have only half a percent coming from other factors besides gas, right? So that was a major factor or important driver in the decline of PCE over the month of, I guess, June or July. Yeah, July, sorry. And so the PCE index for food and beverages has increased each month this year by an average of 1.2%, resulting in an 8.5% cumulative increase in the index year to date through July. For context, the net change in the food and beverages index over the entire 4 year period before the pandemic was only 0.5%, right? And so that's quite a big difference, right? And so, yeah, that's what, double, more than double, just for food. And so let's see, while the moderation of monthly inflation is welcome, it will be necessary to see several months of low monthly inflation readings to be confident that inflation is moving back down towards 2%, right? And so you kind of, more data, typical what you always have to see, right? Or what you always hear, I guess, from the Fed. They always have to have more data, and I mean that's kind of the nature of the beast in a way. So how long it takes to move inflation back down to 2% will depend on a combination of continued easing in supply constraints, right? Slower demand growth and lower markups against the backdrop of anchored expectations. So I kind of highlighted lower markups differently because that's really kind of, I guess, it seems like Brainerd is that kind of type to always be like, you know, it's always the big bad corporations in a way. And of course, I don't want to like put words in her mouth, so to speak. And she cites the automotive industry and retail specifically, um, kind of within this. But it's also like it's worth arguing. Like, what do you expect from corporations and stuff when you have such an event as uh, the pandemic and that sort of thing happen. Like, of course, and also just kind of lower supply in general. Like, if you can't get the goods, period, I mean, you're going to kind of want to increase your margins to begin with, because you don't know how hard it's going to be to get supply again, right? And at least that's what comes to my mind originally. So reductions in markups could also make an important contribution to reduced pricing pressures. Last year's rapid demand growth in the face of supply constraints led to product shortages in some areas of the economy and high margins for many firms, right? And so we do not have hard data at an aggregate level, suggesting that businesses are reducing margins in response to more price sensitivity among customers. At an aggregate level in the second quarter, measures of profits in the non-financial sector relative to GDP remain near the post-war peak reached last year. When I first read this, it's like post-war. I'm like, which war? I mean, unfortunately, not this is America, so unfortunately, you have to ask that question, right? It's like, which war are we talking about? And it's World War II. The data she cites is from the late 1940s, I believe, 1947, right? And so this is talking about a series high of 13.5%, right? So back up, trying to find my place. Sorry. So, using the available macroeconomic data, it is challenging to measure directly how much firms mark up their prices relative to their cost. And basically, it just uses the difference between CPI and PPI, right? So, the consumer price index for whatever sector, and then the producer price index for whatever sector. And I believe she specifically uses, and I think the graph is just automotive. Yeah, for new motor vehicles. And so, you see this difference between CPI increasing and then PPI, right? To where the price that the producers are paying, and this is all indexed, right? It seems from 2017 or so. No, January 2020 is 100 for both indexes. So it just happens to be like that a few years back, right? And so you see this big spread. And I believe she cites the CPI for new motor vehicles grew 3 times faster than the PPI, right? And again, it leads to question the kind of the supply dynamic there, right? And so with the whole like semiconductors, and then like you just couldn't get new vehicles built. And so you kind of, I mean, you have a certain amount of fixed costs. And so is it really like, obviously I'm not in the automotive industry, and so I'm not going to, it's just kind of throwing concepts to the wind, I guess you could say. But like, to what degree is that margin kind of necessary, right, to cover their their costs and everything else, in a way. So it's kind of the same thing comes in with retail as she describes. And so again, the divergence between retail and wholesale prices suggests an unusually large retail auto margin from the graph that we just said, or showed, I should say. So, similarly, overall retail margins, the difference between the price retailers charge for a good and the price retailers paid for that good, have risen significantly more than the average hourly wage that retailers pay workers to stock shelves and serve customers over the past year, suggesting that there may also be scope for reductions in retail margins. But it's also like, I mean, who gets to decide when retailers have to cut their margins, right? It, I don't know. I don't want to turn this into an argument of who basically gets to decide what, because that's kind of a rabbit hole, or if I'm reading too much into it or whatever. This is turning more into just kind of saying the data and trying not to analyze it too much, because it could lead to a very deep rabbit hole, it seems, right? So, with gross retail margins amounting to about 30% of sales, a reduction in currently elevated margins could make an important contribution to reduce inflation pressures on consumer goods, right? And so yes, if you reduce margins, inflation will most likely come down, or at least nominally, I guess. Um, it's kind of like, what are you fixing, right? You're not fixing the problem. You're just, because if you just cut the margins, you're essentially just taking down the profit of the company or the business, whatever. And then, so they no longer have that much of an incentive to bring on new supply. I mean, obviously, with retailers, they're not really bringing on new supply, because they get that from their wholesalers in general. And so it's kind of like, what's the incentives you want to give? Do you want Is the problem the fact that the goods cost too much, or is the problem the fact that there's not enough goods, right? And so does really changing the price of goods fix the problem? And it doesn't. It basically just, you kind of want the prices to go up, right? Because then that would incentivize people to basically make more, and then eventually that would bring the prices down, right? Kind of the whole high prices, or the cure for high prices is high prices, right? That sort of thing. But I don't know. Maybe this is a different world, and whatever. I'd love your guys' opinion on that. To where I've noticed quite a few people a lot more well acquainted with these topics than I, um, have that argument, to where we're no longer in a place, mostly with commodities, it seems, to where the cure for high prices is high prices, and it's more kind of, I guess, secular might be a good word for it. But anyways, so going on to the unemployment rate, which has fallen on net from 4% in January, from 3.7% in August, right? Possibly the strongest indications for the labor market, that the labor market is tight, where the first and second quarter readings of the employment cost index, which point to strong and broad-based growth in total hourly compensation, right? Yeah. So the deceleration in economic activity thus far this year has coincided with only a slight easing in job openings on net since their peak in March. The current high level of job openings relative to job seekers remains close to the largest in post war history, consistent with a tight labor market. Right, here's the graph kind of showing a ratio of the job openings to unemployed. So you can see that it's been increasing significantly, keeping in mind that it's a ratio. And so basically, there's twice as many job openings as unemployed people right now, right? And so you would think that it would be a lot easier to be employed, right? And I'm not really going to read into that too much. Not in this video, at least. So, kind of continuing on with talking about more like yields and that sort of thing, and more like the Fed pivot with inflation. And yeah. So far during 2022, real 2-year yields have risen more than 350 basis points to about 1.2%, and 10-year real yields have risen almost 200 basis points and now stand at 0.85%, in the range of values of 10-year real yields from 2014 to 2018, right? So notice that still the 2-year is higher than the 10-year, which is not supposed to happen. If you think about it, if you lend money to, say, I believe they're talking specifically about treasury bonds, or I'd assume, I don't remember exactly. I don't know. I don't want to waste too much of your guys' time. But yeah, either way, you see the same thing with treasury yields, to where basically it's the curve's inverted, which is not supposed to happen. That's not a good thing. Um, yeah. But kind of to conclude, and I'm glad at least they're saying it as well, because they weren't really doing it, especially a few months ago. And I talked about this quite a bit. And so, to quote her, while we have no control over supply shocks to food, energy, labor, or semiconductors, I like how she threw in semiconductors there, but it was also kind of chastising the automotive industry for the quote unquote excessive margins, right? And so they both have the capacity and responsibility to maintain anchored inflation expectations and price stability. So, what does this mean? What does inflation expectations have anything to do with supply? It doesn't. It's pretty much just demand. And so that's how they have to do it. the Fed can only really influence demand and not really supply, right? Um, yeah. And so the kind of final sentence that really kind of, I think, cements the hawkish view of really getting inflation down and that sort of thing is our resolve is firm, our goals are clear, and our tools are up to the task. Now, that latter statement in the three may be arguable depending on who you're talking to. Um, but yeah, it seems like they're basically hell bent on this. So, something to keep in mind, right? And this video went a bit longer than anticipated. So, thank you for sticking through if you did. And yeah, main takeaways, inflation needs to be brought down, and it seems like they're willing to do anything or sacrifice anything to do that, right? Whether that be jobs, and just kind of the economic jobs or GDP in general. It seems like they're willing to sacrifice it in a way. At least that's what it seems on the surface, right? Only time will tell when it comes time to actually, like bite the bullet and do it. I guess you could argue we already are, but like time will tell is all I'm going to say. So, anyways, I hope you guys have a good night, and I will see you on the next one.